Hey, it's your friend Scott Bennett. I hope you're doing really well. I have a lot to cover, and we have a really big, important theme that I want to cover today. So I need you to stick around and make sure you see it like the way we see it, and you're following trends the way we're following trends. I'm going to share some slides. So, December 5th, all eyes are on the Fed, and we got the PCE, the inflation read today, which we're going to look at. But there's an 87% probability that when the Fed meets on December 10th, we are getting a Fed interest rate lowering. We're getting a cut. The economy is growing, the jobs are lagging, and inflation, again, which if you strip out food and energy, so if you're not eating or moving or heating your home, inflation's pretty tame. So the market is going to be moving primarily on liquidity from central banks. And that's whether at some point that will be horrible, but at the moment it's party on. Before we dive in, we're going to cover a lot of charts, some ideas from our lists. First, just quickest disclosure, this is just information. It's not a direct solicitation to go buy or sell anything. Manage your risk, manage your plan. We'll look at what's going on under the hood of the market. This is Invest with Rules, our self-directed investor research. Our true hope is that it saves you a lot of time, it presents a lot of good ideas, and that it pays for itself. That's our true hope. We plan to do some adjustments based on member feedback in 2026. So there will be some versions of redesign and simplicity. The goal is save you more time, give you clarity. And if you're like, this is totally awesome, I totally get it. We run, this is our trend roadmap strategy, which is billion-dollar funds and trend roadmap, which we do here at Invest with Rules. At our separate business, it's our advisory company. We're a registered investment advisory. It's totally separate. There's never any pressure. We run additional separate strategies that have different trend following engines. They're really exciting. On top of that, we do deep financial planning. If you have any questions, just reach out to us. There's never any pressure. All we do is we want you to be successful and do extraordinarily well. So this morning, we're getting some delayed data. This is CNBC with all their fun advertising. So the PCE, the core personal consumption expenditures, came in at 0.2% monthly rise, an annual rate of 2.8%. So that's telling you that inflation is not an issue. Personal income was up 0.4. Spending was up 0.3. So the consumer is still going despite the job market. We follow trends. As much as I know every one of us wants to know the future, we don't. And the nice people on TV don't know it either. So why don't we just follow trends, do an unemotional trend following approach where you have risk management, because these are just tickers. And we just saw a couple weeks ago that any ticker can fall over 20% extraordinarily fast. So might as well just protect yourself. So let's go through some charts. Before I do, here is the Invest with Rules members area. So when you're in the members area, whether you're in the IWR hub or you go to the live sheet, let's start with the market health section. So you can see what we're doing and what we're thinking. Stock market score, 10 out of 10. This is that kind of market. It just keeps going up. We're 94.4% invested. Our beta is less than the market. So I'm going to share with you some slides in a moment that are going to tell you where most of our capital is: personal capital, advisory capital, newsletter capital, and our portfolio heat is 5.5. Let's just jump into some charts. Let's do SPY, so the S&P 500. This is our trend roadmap. We are testing it in the software called TradingView. It's not ready yet. We're still seeing a couple of tweaks that we need to make. But our hope is that as a member, so thank you, you will get this within a free version of TradingView. So we had a kind of a great run since the U-turn, and we didn't purchase the SPY. We purchased SPMO because it came out quicker in April. But you can see how you had this gas signal, and it has just been a fantastic ride. And just so you know what you're looking at, green is great. It's short-term, long-term uptrends. It's the gas signal. The yellow is a coast signal, short-term down, long-term up. It's just like a pause. And whenever you see a green arrow above the bar, that means that there's a higher probability that there's a chance it goes higher. It's a probability. There's no guarantees in this world. If there's an orange box below the bar, that means that's on an overheat, an RSI, relative strength index, above 68. So you're getting a little stretched. So it makes sense. There's times where you get a bunch of cluster of orange and you pull back. And then you come up and you got a cluster of orange and you pull back. And sometimes it's like it could muster and then it falters. And you're getting a green arrow today on the SPY. So let's look at that. So there was a really rough patch just recently, and the market had a normalized pullback. We were prepared if anything were to poorly happen. The green line is the 21 exponential moving average. The red line is the 50-day simple. The black line is the 200-day simple. We're actually approaching all-time highs. That's what the SPY is telling you. The volume isn't there, but the stimulus is there. So we're going to go to what I believe would be some of the more important charts in just a second, but let's go back a moment and look at the market health. So the short-term trend for us is about a month. The long-term trend is roughly a year. And then we have some kind of algorithm programming that helps us to determine all the details. What we're looking at here is about 2 weeks of data. So this is even more short term, and it's telling you where the strength and the weakness is because the rotations can happen pretty quick. And off to the right is relative strength. Off to the left is relative weakness. Healthcare is still your top dog. I know today it's a pullback, but it's still your top dog. Same goes for gold. And lo and behold, consumer staples are here too. You're seeing a big move the last 2 weeks. You're seeing a move in communication services, real estate, and you're seeing this kind of rotation constantly happening. And we'll look more at the SPY and the Qs compared to something that you're going to want to know more about in just a second. If we look at the mega caps, I'm looking at Walmart over the past 2 weeks, adjusted for volatility, it is up big. 7.7 is the short-term volatility adjusted momentum. Eli Lilly, 6.3 is our short-term volatility adjusted momentum. So return over roughly, call it days, you divide that by, or you apply its volatility measure, and this is what's been doing well. It's been Google, it's been Berkshire. What has not done well? On coast is Microsoft, Oracle, NVIDIA. We'll look at a chart. NVIDIA is not looking like its friends. And then you're seeing Visa on a break. You're seeing Bitcoin on a break. Had a bounce, but still on a break. And today got its clock cleaned after a really good week. So here's the SPY. And you can see how the SPY, meaning the S&P 500, is really close to its all-time high. Let's now look at the NASDAQ 100. But look at the difference. So you can see how the SPY is right around over here. And look how much lower the NASDAQ 100 is. So I still believe that people dump money into index funds. It's still going to go to these Mag 7 and still do well. But from a relative standpoint, comparative to the S&P 500, it's not doing as well. So that's why we're at half positions. It was a reason for us to do something really important. So I'm going to pause for a minute and just share a slide that I think that I wouldn't buy DBC personally. It's a tax nightmare. It's a bunch of futures contracts, and for some reason they issue a K1 and it's a nightmare on your taxes. But I think this is the story. Now, 53, I'm going to hope you pause the video here. 53.5% of our trend roadmap portfolio today, they're in commodity related investments. This is where the puck is moving, and I don't think we're late at all. So I'm looking at a monthly chart of the DBC. And this is a very imperfect ETF. So I want to be clear, but we're looking at a basket of commodities. It's oil, it's precious metals, it's hard metals, it's soft commodities like food and agriculture. It's a whole basket of stuff. And you can see that it's been horrible for a very long time, and then it made this massive run up after COVID, and now it's formed this crazy looking base. I'm going to just double click, and I don't really care much for the moving average convergence divergence, the MACD, but what's super interesting is look at this. So the last time you got your moving average monthly convergence, divergence, uptrend signal was right after is in the throes of COVID. So if I remember right, so you had like right over here, December 1st of 2020, this was all your COVID mess. And then look at that run. It went from 11 to 27. Pretty crazy, right? And you've been basing, you meaning the commodity index, has been basing since 2022, 23, 24, and it is starting to poke its head over the highs of this shelf. And lo and behold, here's the MACD just crossing over now. So oils, precious metals, which is already run, and a whole bunch of this is spreading. So could it get from 23 to 27? Could it get all the way back to its all-time highs? But I think it's really important to just, we're going to zoom in and look at the fact that the highs from November 11th, you're right above the high. The S&P 500 isn't. The Nasdaq isn't, but the commodity baskets are. So I think this is really interesting and clear. We're roughly flat in our position. We added a little bit of a half position in XME, but this is where we're really riding the trends. Here's a chart of gold. IAU, it was forming a wedge, it broke out, we increased our exposure. We've had this exposure for a very long time. I think 2023, if it serves me right, it was a gas signal. Let me clean this up just for a minute. And I go all the way back, all the way back, October of 23. Look at that run. Nuts, right? So let's zoom in and then we have positions in gold. We have positions in gold miners. Right cup handle squatting today, but that's normal. And it's made a really good bounce off of the 21 EMA and the 50 EMA, and now it's just pausing. That looks totally normal. And could it even finish the day in the higher part of its range? I think that could possibly break up and out. Let's look at silver, SLV. It's on an overheat, so for us that means pause, but you can see how the cup, the handle, the breakout, and could one of the way our gas signals work, you would have gotten the signal here, and you would have still been above it all that way. I'm going to show you a super long-term chart of silver, why even though it's on an overheat today, it's finally back to its 2011 highs. So this could go way higher than one could imagine because it's just finally at that area and it's finally breaking out. Could it come back down and test and then make another rocket higher? Of course. Let's look at copper. Gold, silver, copper. Copper has broken out, COPX. We have a full position on an overheat today. You see how it all, this is, if you saw on our charts, you'd see this was the gas signal and up it ran. I'd say something a little bit more volatile would be the rare earth metals. So if you think the government invested in MP materials, so they want to have exposure no matter what happens in the geopolitical realm. If there's a battle over the dollar, let's say foreign governments have nothing to do with US bonds anymore. They could care less about the US dollar. Where is the money going? Gold. That's where it's going. What's the fight over? Rare earth metals. You're forming a wedge. Yesterday was ugly, and today you're filling the gap and you're doing fine. It would be interesting if it could break up and out. If one's a more of a shorter term trader, that would have been a lot to handle. But you're still on a gas signal, despite this is a volatile ETF. It really is. But today, so far, so good. We'll keep working our way down in the commodity complex. We have a full position on RSPG, equal weight energy and oil. It formed a break to a coast. This is a sloppy looking chart, but if we zoom out, you're just breaking out now. It's been going nowhere since 2024, 2025, and now it looks like you're just breaking out. So that's equal weight. You're going to see on the watch list today the energy ETF. Let's look on a daily. Looking good. That's primarily weighted by Exxon, which is just holding in here, consolidating. And Chevron doesn't look as good, but this is why we went to the equal weighted. It looks better. It has already broken out. Could it come back down and make another run higher? Sure. So I hope that's clear. So our exposure, which we can change based on trend and based on action, 53.5% are exposed to commodity related investments. So whether it's physicals, whether it's precious metals, whether it's companies, whether it's stocks like Valero, which is consolidating nicely, whether it's there's a few others that we're looking at. I think we're flat to down in this position to start with, but Franco Nevada coming off of forming the right side of its cup. We grab the gas signal, see how this consolidates and then springs up and out. But there's a lot more exposure to the precious metals on our billion-dollar fund manager report. Let's just see if there's anything else to cover. Oh, I want to cover, we had earnings this week from Dollar Tree. We had a good reaction post earnings. The funds are here, the trend is here. You're on an overheat and you had a breakout. So that all looks good. If you're owning it, I don't see anything wrong. Obviously, manage risk. But today, the consumer is stretched. And where are they going to make their dollar work harder? Dollar Tree. That's why the funds are there likely. It's 3 great days in a row. It would make sense for it to pull in at some point relatively soon. Not everything works. In the internet, everyone's a genius. But in reality, we are humble and we don't care about these tickers unless they're doing well. We don't care. We will cut them. Snowflake. The funds are buying Snowflake. But the reality is the earnings were great, the sales were great, but the expectations of future margins and future growth were a little weak. And the market has punished it yesterday, and it was painful. We had a half position and we cut it. And today it's down another 3%. And that's why we do that, is simply because it can get worse. I would expect it to hold around here and I'd expect it to turn. And why not just simply wait for another gas signal? And if you love Snowflake and you think that they have a great kind of data set and data center, and you're a long-term investor, then one can hold on a coast to manage your risk. And just simply, it will form some version of a gas to reload. But could this go all the way back down to the 200-day simple? It's possible. It's really possible. I would hope it could undercut this low like it's doing now and then rocket out next week, but I don't know. That's the answer. What looks better in the tech space? So we do have exposure to tech. We do have exposure to healthcare. I want to be clear that we are diversified. We're not just in one area. But if you look at something like a Micron, which reports on December 17th, this is above the 21-day exponential. It's above the 50-day simple. If you were to look at the probably most owned thing, it's NVIDIA, and it's underneath the 21, it's underneath the 50. It hasn't really gained muster after its overheat signals. Micron. So here was support, and it held it, and it dunked underneath it. And if one was to say, okay, right now you're probably playing for this trend line, and you're right at it with the closes, and could it explode up and out? That'd be great. We have a sizable cushion, highly likely we're holding into earnings at a half position, up over 80+%, maybe closer to 90% today, but that's what's going on. Okay, so I'm going to pause there. Thank you for your time. I hope this was helpful running through some charts and what we're thinking. I think the bigger themes are we're going to watch the dollar, the trend of the US dollar. We're going to watch the commodity complex, the tech complex. But the market is still acting really strong as the Santa Claus rally looks to appear to be gaining momentum. We'll keep watching, we'll keep following trends, follow the trend, follow big money, follow a lot of risk management rules. At the moment, the coast is clear. In the future, I think there's if the government process keeps making the world stimulating, if interest rates are falling, if you're hiring a new Fed who's going to be lowering rates further than people expect, it's a party on. So I wish you and your family a happy holidays. Have a good weekend. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.